Hello friends, a very warm welcome to my channel. In today's video, we are going to talk about another technology company which is working into a lot of sunrise sectors. Recently, one of their subsidiary is also listed. So we are going to talk about Cyient Limited, which has a long legacy and which is very different from the other IT companies in this space. So if you are new to the channel, please do subscribe and hit the bell icon to get updates of all the new videos which we upload. And if you're not a part of our Telegram channel yet, do join today as we discuss every day morning the portfolio strategies and my market view, which will help you manage your portfolios much better. Join the channel by clicking the link in the description button so that you join the correct channel. Let's talk about Cyient Limited. This will be the flow of our discussion. We'll talk about the business model in brief. We'll look at the chart. We'll look at the financial performance in the last few years. We'll discuss why the stock has given a run up recently. We'll talk about the outlook of the management in FY25 and beyond. We'll look at the valuations of the stock and then form an overall view as to what you should do in this company. So Cyient Limited started from Hyderabad as a headquarter in 1991 and now it is a multinational company getting most of its revenues from outside India. So US contributes to a majority of the portion of the revenue and then Europe is the second contributor. So this is not a normal IT or software development company. They are a tech company focused on engineering and research and development. He also has a subsidiary which is into design-led manufacturing, which is again a sector which the government wants to promote as their China Plus One strategy. So DLM has three manufacturing units and as I said, it's a R&D driven company having their own research and development department and they do significant spend in developing new products in terms of software products as well as the DLM part. So it's a cash rich company. When you listen to the management, they always talk about generating free cash flows. They also focus on the same in the presentation if you review. So as they generate enough cash, they have also been active in acquiring companies. So they have acquired more than 20 companies in their journey so far. 29 out of Fortune 500 companies are their clients, which speaks a lot about the quality of service of this company. So these are the main business segments of the company. Broadly, they can be classified into three. The first one is Cyient DET, which stands for Digital Engineering and Technology. Then they have DLM, which is through their subsidiary, and a minor portion of the revenues comes from other services. Now, in terms of industry verticals, the DET covers these verticals on a broad level. They focus on transportation as a sector. Now, in transportation, their majority of the revenue comes from aerospace. So now again, this is the area of focus domestically as well as by the countries abroad. So for the next few years, the company expects to do well in this space. Coming to communications, again, telecom and communications is the focus of the government in India, and the next few years have expected to be good in this sector. Sustainability is a focus of all the companies across the globe. They want to go green, they want to grow neutral in terms of the carbon emissions. So if you see the last few years financials of the company, the growth in this vertical has been much higher than the other verticals. And it's a R&D driven company, they keep entering new segments, like they have ventured into the semiconductor space and they also have presence into the automotive sector. Now when we talk about their first division, which is DET, this includes services in terms of the engineering, R&D, digitization of maps or the geospatial services, reverse engineering if you want them to develop any product from scratch. The usual software development part also forms a part of this vertical, and they also develop their own software products to a certain extent which are sold as SaaS products across the globe. This is an overview of their design-led manufacturing division, which is done under their subsidiary Cyient DLM. So they do end-to-end manufacturing right from the conceptualization or the prototype stage till the development and manufacturing of the product, and post that they also do the maintenance part. When we talk about the products that are manufactured in this segment, they manufacture electronics products, wire harnesses. They do assembly of the PCBs which are widely used in electronics manufacturing, and the consumption in India of this product is going to increase drastically in the coming years. They are also into aerospace. That has been a primary area of focus for this company. When you look at the revenue breakup, the DET constitutes a majority of the revenue of the company. Roughly about 80% comes from that vertical and the remaining about 15 to 20% comes from the DLM division. A minor portion of the revenue comes from the other services. In terms of verticals, it is well diversified. Transportation, which is aerospace and rail, constitutes about 30% of the revenue, another 28% from sustainability. Then communication and telecom constitutes about 23%, and the other semicon and the new areas which they form, they constitute about 20 to 25%. So you can see that in terms of sector, it is fairly diversified. One advantage of diversifying like this is you are not dependent on one sector for your growth. But the disadvantage is in every year, few sectors perform, few sectors have headwinds. So overall growth of the company gets impacted. This has been the stock performance in the last few years. Pre-COVID, it was consolidating for a long time. It made a high of somewhere around 900 pre-COVID, but post-COVID, after the correction in 2020, there was a steady rise in the stock price and it went up to almost 2,400 rupees. Right now, it is trading at somewhere around 1,800, and the management is guiding for high single-digit growth this year. So we cannot expect any fireworks on the chart, and this year could be a year of consolidation for this stock. If you look at the revenue performance, there was a small dip in FY20, which is from 4,400 crores to about 4,100 crores, which went up to almost 7,150 crores in FY24. So there was a steady rise in revenue. So in the last 3 years, the company has done well. They have grown by almost 20% CAGR in terms of revenue. When you look at the EBITDA, it has done better in terms of profitability. Even in the COVID year of FY20, the EBITDA did not fall. It went up from 540 to about 575 crores. And now it has reached almost 1,300 crores, which is much better growth than the revenue. Why this has happened? Because the margins have expanded. Earlier, the company used to do about 12-13% kind of margins, which steadily expanded to almost 17 to 18%. So, which is a good sign that the company is commanding some premium in terms of service and the product from the customers. And hopefully, the company expects to maintain this margin going forward also. Promoter holding is just about 23% in this company, and FIIs and DIIs hold a substantial stake. So this could be an area you should closely watch for going forward. It's a cash-rich company focusing a lot on the free cash flow. And if you see their balance sheet, they have almost 1,000 crore cash lying on their balance sheet, and they have massive amounts of investments also. In terms of sales growth, the last 3 years CAGR is about 20%, 5 years 9%, and 10 years around 12%. So why I'm trying to show this here is, historically the company has not performed so well in terms of sales growth, because as an investor we always look at companies growing faster than 15-20% and upwards. But last 3 years have been better. They've grown by almost 20%. In FY25, they are again guiding for a single-digit growth. So this 20% growth trajectory which they are maintaining in the last 3 years will get impacted. So this is a very important point I want to convey for this company, that in terms of sales growth, it has not been very consistent, and in few years they have shown decent growth. But over a longer period of time, if you see, they have not been able to grow by 20%, more than 20% CAGR consistently. That could be one of the reasons why this stock is not getting a very high valuation multiple. Now, what led to the recent rally in the stock post-COVID? The sales went up continuously, the margins expanded, which led to higher profitability. They have entered some sunrise sectors like semiconductors and aerospace. So this focus has led to the re-rating in the stock partially. So due to all these reasons, we saw a good rally post-COVID. Now, what is the outlook of the management going forward? As we have discussed, in FY25, they are giving a guidance of high single-digit growth, so it could be somewhere around 8-9%. In terms of margins, they are guiding for earnings before tax of about 16%. In this year, which went by, they got a total order of about $900 million, and in their subsidiary, which is into DLM, the order backlog is somewhere around 2,000 crores. And DLM also wants to focus on the defense and aerospace, as they are expecting good orders from this sector. So overall, the growth seems to be good. In a longer time frame, if you see, there could be a steady growth in the company, but only when they receive some very big size orders in the areas of defense and aerospace, the company can grow more than 20%. These are their recent deal wins or tie-ups which the company has done. They have tied up with Deutsche Aircraft. They also tied up with Airbus. So tying up with this kind of companies in sectors like aerospace will open up a lot of doors of opportunities for this company. Now, in terms of valuations, the stock is trading at somewhere around 27 times the FY24 earnings, which is not very expensive, especially in this sector when you look at other companies. Price to book value is about 4x, and the market cap to sales is just about 2.8x. So overall, the valuations have not been expensive, but historically this company has been getting a multiple of about 18 to 20 times. Now, if they are able to maintain this run rate of 20% growth going forward also, then these valuations of about 25 to 30 times will get maintained. But if they go back to that single digit kind of a growth of over the next 2-3 years, then the valuations may get derated also. So it totally depends on how the execution happens and what vertical is contributing to that growth. Let's say sectors like defense and aerospace generate massive orders for this company in the next year, then the valuations can get further re-rated upwards also. What are the risks of investing in this company? Historically, the growth has not been very impressive. So there is a risk of poor execution in the future also. They are entering new verticals, so we are not sure how successful will they be in these new verticals. The promoter holding is less, and in few of the industries which they focus on, they have shown degrowth compared to the earlier year. So not all the horses for this company are performing. So now that you've understood the business model of the company, the growth prospects of the company, the financial parameters, the valuations part, and risks of investing in this company, what is our overall view? If you're already invested in this company from lower levels, you should continue to hold, as the company is working in some new verticals. They have done good tie-ups in the recent quarter. So although FY25 can be a muted year for this company, but FY26 could be good. So if you are a long-term investor who can patiently wait, then you can give them a chance 2 to 3 quarters more and see whether they revise their guidance upwards or not for the next year. But if you want to take a fresh entry, then you will have ample time to enter the stock, as for this year as FY25 is not so great. So the stock is not expected to give a very big run up this year. So it may remain in consolidation stage. So gradually, as in when you hear management talking about higher growth, then that could be the right time of entering this stock. So that's about Cyient Limited. I hope you like the crisp video. I have tried to highlight all the important points you should know as investors in the time frame of about 8 to 10 minutes. If you like it, hit the like button, subscribe to the channel. If you want me to make videos on your favorite stocks, to mention those names in the comment section. Do join our Telegram channel using the link in the description. Thank you for watching and have a wonderful day.